Hello, everybody. Welcome back to Finance with Benvi, where we simplify topics to make you understand. Today, we're diving into the power of diversification in investing. Without further ado, let's get this show on the road. All right, so for our agenda today is number one, what is diversification? Number two, why diversification matters. Number three, how to diversify your portfolio. And number four, challenges and considerations. All right, so what is diversification? So, diversification is a risk management strategy that involves spreading your investments across different asset classes and within those asset classes to reduce the overall risk in your investment portfolio. The idea is simple. Instead of putting all your money into one type of an investment, you spread it across multiple types. This could mean investing in stocks, bonds, real estate, and other asset classes, as well as diversifying within those categories. For example, by investing in different industries or geographic regions, the goal is to ensure that if one investment performs poorly, the others may perform well, balancing out the overall performance of your portfolio. Purpose. The purpose of diversification is to manage risk and improve the potential for returns by not relying too heavily on any single investment or market sector. When you diversify, you're essentially betting on a variety of outcomes, which can help protect your portfolio against significant losses. Diversification recognizes that no one can predict with absolute certainty which asset or market sector will perform the best in any given period. By spreading your investments, you reduce the risk of being overly exposed to one area that might underperform. Example, imagine you've invested all your money into a single technology stock, and suddenly the tech sector experiences a downturn. Your entire portfolio could suffer a significant loss. However, if you had diversified your investments by also holding bonds, real estate, or stocks in your in other sectors like healthcare or consumer goods, those investments might offset the losses in your tech stock. For instance, while your tech stock might decline, your bonds might provide steady interest, and your real estate investment might even appreciate. This balance can help smooth out your overall portfolio performance, even during volatile market periods. Why does diversification matter? So, it matters for three reasons. Risk reduction. Diversification is one of the most effective ways to manage and reduce investment risk. The logic is that different asset classes and sectors don't move in tandem. When one goes down, another one might go up, or at least not go down as much. This balancing effect helps reduce the overall volatility of your portfolio. By diversifying, you're not overly dependent on the performance of a single investment. For example, during an economic downturn, while stocks may suffer, bonds often perform better because they are considered safer investments. Similarly, if a specific industry is hit hard, investments in other sectors may not be as affected, thus reducing the impact of your overall portfolio. All right, so for steady returns, a well diversified portfolio tends to generate more stable returns over time compared to one that's concentrated in just a few investments. This is because the gains in one area can help offset losses in another. Over the long term, this stability is crucial for achieving your financial goals, whether they're short term, like buying a house, or long term, like retirement planning. For example, while the stock market can be volatile, historically, it has provided higher returns over the long term. By diversifying your portfolio to include a mix of stocks and bonds, you can enjoy the growth potential of stocks while mitigating risk with the stability of bonds. Long-term growth. Diversification also plays a key role in long-term growth. By holding a variety of investments, you increase your chances of participating in the growth of different markets and sectors. This can contribute to the overall growth of your portfolio. For example, if you're invested in emerging markets, which have higher growth potential but also higher risk, and you and also in developed markets, which are also more stable but offer lower growth, you're positioned to benefit from the growth in both areas. Over time, this diversified approach can lead to more consistent and substantial your portfolio growth. All right. So for our next topic, we have how to diversify your portfolio. So we have three things. Across asset classes, one of the fundamental ways to diversify is across different asset classes, such as stocks, bonds, real estate, and commodities. Each asset class reacts differently to economic changes. Stocks, for example, might perform well in a growing economy, while bonds might be more stable during downturns. Real estate can provide income and potential appreciation, and commodities, like gold, can act as a hedge against inflation. By holding a mix of these assets, you can balance the risk and return profile of your portfolio. For instance, if you allocate 60% of your portfolio to stocks for growth, 30% to bonds for income and stability, and 10% to real estate for diversification and potential appreciation, you're spreading risk across different asset classes. All right, so the next topic is within asset classes. Diversification doesn't stop at the asset class level. It's also important to diversify within each asset class. This means, for example, investing in different sectors with your stock holdings, such as technology, healthcare, and consumer goods. It also means spreading your investments across different geographic regions, such as the US, Europe, and emerging markets. This approach helps you mitigate the risk of being too heavily exposed to any single sector or region. For example, if you only invest in US technology stocks, your portfolio is at risk if that sector underperforms. But if you also invest in healthcare and financial stocks, and perhaps in international markets, you reduce that risk. Rebalancing. Diversification isn't a one-time task. It requires regular monitoring and rebalancing. Over time, some of your investments might grow faster than others, which can change the risk profile of your portfolio. Rebalancing involves adjusting your holdings back to your desired asset locations to maintain the appropriate level of risk. For example, if your stocks have performed well and now make a larger percentage of your portfolio than you intended, you might sell some stocks and buy bonds or other assets to restore balance. Rebalancing ensures that your portfolio stays aligned with your financial goals and risk tolerance. Let's go ahead to our last thing: challenges and considerations. All right, so we have also three topics here. So number one, diversification. While diversification is key to managing risk, it's possible to over-diversify, which can dilute potential returns. This happens when you spread your investments too thinly across too many assets, making it harder to achieve strong performance. The key to find a balance between diversification and concentration in high quality investments. For example, owning 50 different stocks might not necessarily provide better diversification than owning 20 carefully selected stocks. Over diversification can lead to increased costs and complexity, without significantly reducing risk. Costs. Diversifying your portfolio can involve higher costs, especially if you're investing in mutual funds, ETFs, or other managed investments that charge fees. Additionally, frequent buying and selling to maintain diversification can incur transaction costs. It's important to be mindful of these costs as they can eat into your returns over time. One way to manage costs is to use low-cost index funds or ETFs that provide broad market exposure and diversification at a lower expense ratio. Monitoring. Effective diversification requires ongoing monitoring and management. As market conditions change, so do the correlations between different assets. What was once a diversified portfolio might become less effective as markets evolve. Regularly reviewing and adjusting your portfolio helps ensure it remains diversified and aligns with your financial goals. This doesn't mean you need to make constant changes, but periodic reviews, at least annually, are important to ensure your strategy remains effective. Don't think I forgot about the quote of the day because I did not. So, the quote of the day today is Diversification is the only free lunch in finance. This is by Harry Markowitz. This quote emphasizing that while risk is inherent in investing, diversification is one of the few strategies that allows you to reduce risk without necessarily sacrificing returns. It's a reminder that spreading your investments wisely can provide a level of protection and growth that wouldn't be possible without a concentrated portfolio. Thank you for watching Finance with Manvi today. I hope you found this deep dive into diversification helpful. If you enjoyed this video and want to learn more about smart investing strategies, don't forget to like, subscribe, and hit that notification bell. See you in my next video.